Although to the main event here today, which is JPMorgan saying gold could hit $6,000 when Trump's term ends. Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on Tuesday, May 13th, where we have plenty to dig into, including JP Morgan talking about how they see gold hitting $6,000 an ounce by the end of Trump's term, which, gee, that's under 4 years now. So interesting notes from them. And obviously, a lot happening in the gold and silver market. So, with that said, let us dig in. First, with a quick look at the gold price, and in just a moment, I'll also give an update on this morning's CPI report. But here you see the gold futures back up $21. Oh, there you go, $22 after yesterday's shellacking that left the prices down 118 at one point. I saw it, it finished down over $100. So good to see the price rebounding. And I also remember thinking last week on one of the other sell-offs, which it sure is intriguing how now gold goes up or down $100 on a day, and here when you have gold up $22, it's almost like you just yawn and sleep through it. But secondly, just that you could have gold go down $100 and still be over $3,200 an ounce, which I would suggest back in the dark days of September of 2022. I remember going to the silver symposium. Silver broke below $18 the first day, I think it was, that we were there. That was some grim times. And let's see where that is pulled up last night. Here's the gold price back during that fuzzy time period, down at 1654. So just imagine if someone had told you back then, hey, in a little while we'll have gold be down $100 and still be over 3,000 an ounce. So certainly encouraging times. And again, quick look, here is our high, all-time high in the futures, 3509, which was not too long ago. Quick look at silver, which is now picking up some steam, having a good day there, has climbed higher, now back over 3309, the 33 level at 3309, up 47 cents on the day. Interesting to see silver doing as well as it is, given that we've had a rebound in the dollar index. Let's pull back the 1 month chart. You see it got below the 98 level back on, that was April 21st. Rallied since then, including in the last couple of days, the 11th. Guess this was Sunday night, and obviously with the announcement of a trade deal that wasn't really agreed upon, it seems more like a truce and just we won't light each other's assets on fire at a more rapid pace. We'll pause here. Yet, anyways, you can see that was enough to send the dollar index quite a bit higher, back over 101 as we speak. And something else to keep an eye on, because here is our 10-year bond yields. Well, you can see, well, you've had in the past couple of months, obviously here was right after Reciprocal Tariff Day, Independence Day, as I hear they called it. Yield really dipped down, then skyrocketed, got up to, looks like a high of 459 there. Came back in and is a bit higher now, back just under 450. Although what is interesting, I was thinking, obviously, we've had a couple of run-ins where the bond yield has gotten, let's take the look back here, close to the 5% or even above the 5% level. I believe it hit there. So we've seen this a couple times in the past few years, a few peaks here up to 473, similarly there, getting up to 464. You see that move index, which is the volatility of the bond index, spike when you get anywhere near that 5% level. And I agree with what Luke Roman points out often, where he says anytime it's gotten near 5%, you've seen Treasury get nervous, often do some form of dollar liquidity, which I would imagine will probably, well, it's interesting, even though stock market getting clobbered, Powell is not, he's not cut rates further yet. Obviously did have that 50 basis point cut, which was pretty aggressive, yet he did leave rates steady and actually continued hiking them through the bank failures in 2023. Yet, with all that said, taking a look at our yields here, you see that obviously these were in the past couple of years, as I mentioned, because this is the long-term chart, but not a technical charting analyst, but gee, seems like you're at that level that hasn't gone through since when 2007, right before another bubble popped. And I know maybe I overfocus on that since that was such a seminal point in my own financial career. Yet to say that in the time since then that the conditions we're facing now might be the most facilitative. Yeah, I'm gonna imagine that's a word or create it if it's not. I mean, the conditions are in place for something similar to that, especially the longer the trade war goes on, which, truce or not, you're still having damage done to the supply chain. As I've mentioned several times in the past few weeks, I don't know, concerned. I mean, I think I'll be all right, but to the degree that we have noticeable supply chain disruptions this summer, I still would stand by that. And certainly the fact that trade war is continuing on, even if not accelerating, would support that. The longer that goes on, the more likely that would be to occur, unfortunately. But anyway, according to the government, inflation's coming back down. Annual inflation rate hit 2.3% in April, less than expected. Well, I won't do it today, but some other day I'll share my thoughts on the whole Wall Street expectations, where guess whoever is setting the expectations can have an impact on the price, which obviously, if you followed Wall Street, you know that happens a lot all the time. Maybe I can't even imagine. I'm fortunately not in that side of these things now, but can't imagine how much it still continues to go on today yet. Nonetheless, CPI 0.2% in the month, 12-month rate at 2.3%, lowest since February of 2021, although the core CPI came in at 2.8%, which is exciting in its own right because you can see we've finally gotten back below 3% for the first time since April of 2021 back here. I guess technically last month we hit that 2.8% again. So with that said, gee, it sure seems difficult environment to imagine inflation coming down in and staying down in, given what is happening with trade wars, supply chains, whatnot. But we will see how that goes. Although, to the main event here today, which is JPMorgan saying gold could hit $6,000 when Trump's term ends. Not all that far off. And I guess when you think about how the price has doubled in the past few years, another doubling in 3.5 years, wow, would you take the over or under on $6,000 gold by 2029? I'd put the over. I'd take the over on that. I would. Um, sure would be fun to go 4 years into the future and see how that works out. But we'll get there soon enough. And there, JP Morgan, while we're waiting until 2029, JP Morgan reinforcing their bullish case. And here we go. According to analysts, this could realistically occur with just a small allocation away from U.S. assets under the current macroeconomic climate. And this is something we've talked about before here. And fortunately, let's see if I can get a copy of this report, because I've always heard Rick Rule talk about this, but even with 0.5% of foreign held U.S. assets reallocated to gold, that would result in 18% annual returns and eventually send prices to $6,000 an ounce, they said last week. And even a minuscule boost in demand can create a big price swing, it explained. Huh. Well, if that could happen in the gold market, what about silver, where the supply is about 1 billion ounces a year, 32, $33 now? That's only 33 billion versus they're talking here about an estimated inflow of 273.6 billion. So while I'll be the first to admit that it has not happened yet, if you ever do get central banks or governments or even the public going back into silver, at least what they're talking about here of how a minuscule boost can create a big price swing. I mean, there you go. And now I love this part. They call it tooting your own horn. I'm going to do that for a moment, so bear with me here. But driving the rally in gold were years of geopolitical turbulence and economic uncertainty. I think we've talked about that a little bit here, which were exacerbated by the election of Trump, who has launched an unprecedented, they said launched a unprecedented trade war, but I'm going to go with launch an unprecedented trade war that is eroding investors' confidence in the dollar. So feel free to go to goldandsilverdaily.substack.com or on the Arcadia channel. And you can find back in November or even earlier than that when we heard Trump talking more about tariffs and how that was the plan to shore up the system. And you saw the dollar rallying going from under par back in September to over 110. And what I was saying back then was that I wonder if once these policies start to get enacted, that the idea that this is going to strengthen the dollar, there might be a much different view on that, which is certainly what has happened. Now, here, JPMorgan talking about unprecedented trade war that we knew going into Trump's inauguration. Maybe we didn't know how unprecedented it would be, but basically trade war because of the tariffs. And now they're talking about eroding the confidence in the dollar. Swish. Sorry, I'm done. I'm done now. Although we get some of these right here. Fortunately, I don't put price targets on it, so I can't screw those up too badly. But I don't know. I hope that was helpful hearing that back then, whether you agreed or what you did with that. But hopefully, at least that was helpful. And hit the subscribe button if you want some more. And anyway, according to JPMorgan, the Trump administration of burden sharing by other countries that benefit from the dollar's status as reserve currency have also put foreign investors on notice, prompting its bullish case for gold. And of course, we shouldn't forget how Goldman Sachs had their gold report out a couple of weeks back, 2 weeks ago, was it? And yeah, geez, that was over a month ago. And they were talking about how gold could exceed $4,500 an ounce in an extreme tail scenario. I will maintain what I said back then. I mean, extreme tail scenario, is that not what we're in now, where even you have everything going on with the trade wars, but behind all of that is what I would describe as perhaps an acceleration of, or not, let me rephrase that. I feel it's already started, and now we're accelerating to the point where it's not just gold and silver bugs talking about the deficits and debt and treasury this and that, but I think we're seeing now, perhaps through these past couple of months more overtly than ever, an acceleration to that point where, aside from opinions, that the structural foundation we've known with the US Treasury used as the store of value supporting the oil market is starting to break down to the point where it is not working from an investment and financial standpoint anymore, forcing many of these things that we've seen here. And anyway, so I think we're in the extreme tail scenario. And again, you have the biggest Wall Street banks, one talking about $4,500 gold, the next talking about $6,000 gold. And this is before, I would say here or in other places, obviously the issues with the Treasury come up, but not mainstream there yet. And when that does become the case, because here's a simple way of looking at it. At the end of the day, with the debt, and whether it's funded through printed dollars, which most likely it will be, if you're of the school of thought that that money it's not going to be repaid by U.S. growing faster or finding some unknown technology that boosts productivity. So if you accept that, then someone is going to have to pay for the money that was lost. Now, that could be a haircut to bondholders. that could, and most likely, probably will be a combination of several at some point. But obviously, if the currency is devalued, that's another way. But someone is going to lose. I think at some point, the bondholders are going to be one of the bigger losers in that unfolding of the government sovereign debt bubble. And anyway, I think we're in the extreme tail scenario. We shall see. But few final notes before we wrap up. I wrote about this one a week or two ago. Not sure if I talked about it on the show, but worth repeating because I'm not going to claim to know exactly what's going on in Ukraine. Yet there was this quote from Trump recently, who was where he was critical of Putin, saying, "It makes me think he doesn't want to stop the war. He's just tapping me along. Has to be dealt with differently through banking or secondary sanctions." So just something to keep in mind as we watch this move forward, because you'll have that in the background of everything else that we just discussed. So fortunately, with that said, in terms of some safer places to think about, we have Fortuna Mining, and by all means, mining stocks have risk inherent. So please do your own due diligence. Yet if you have been watching the gold price at the record highs, even if we're slightly off that, Fortuna Mining, certainly a company that I feel is quite well run. I've seen two of their mines in person. We do our regular calls with Jorge Ganoza, the CEO of Fortuna Mining. We actually just did one last week following their earnings where they reported record free cash flow in the first quarter. Another record, set a couple of those in the past couple of quarters. And in either case, Jorge gave a great rundown of where things are headed. And also, they had news out this morning as they've completed the divestiture of their Yaramoko mine. Did mention recently how they sold that mine at as it was coming to the end of life, and frees them up to reallocate approximately 50 million of capital and management capacity as well. And in that call, which I'll link to at the end of this one with Jorge, he talked about exactly what the plans are, because that does make them a smaller gold producer. Although I don't know that that's necessarily a bad thing, especially because one of the things that Jorge talked about is how they're focusing on getting low cost ounces. They could go increase production back to the prior levels, but being selective, which especially with a large portion of the mining equities market still a bit depressed, I do think there's good value out there. Plus, they do have a handful of projects that they're moving forward. Most specifically, in addition to Seguela, would be the Diamba Sud project in Senegal that they bought from Chesser Resources. Gee, I guess that was 2, maybe even 3 years ago now. But anyway, can find out more about the details of the Yaramoko sale. Link in the description field below. Although you can hear about it yourself from Jorge by just clicking on this video that's coming your way now.